Hey there, traders, investors. Todd Gordon here with New Age Wealth Advisors. It's Tuesday, 3:15, and I just want to do this quick video update. Man, just hearing so much about the 10-2 spread and just how certain of recession so many people are, and I really started kind of getting behind it and doing a lot of research on it today, and I want to share that with you. I think there's some important things going on there. So I hope you guys are well. And, as it relates to, sorry, music, so let me turn this down. Specifically, as it relates to the recession, pending recession, what to do with the equity market, but also specifically about our position in financials, which are pretty overweight right now. I'll just go ahead and show you our two main portfolios in the wealth management business, and I just want to show you the financial sector allocation, and very much related to these yield spreads. Is it time to get out of financials that have worked so well? And also related to this are the energy stocks. Is it time to get out of the energy? So this is our growth portfolio, and this is our weighting in financials, which is 10.78%, which is a little underweight the S&P at about 13 and change, 13 and a half. But if you think about it, to even have, for me, those of you who've been following me for a while know I loved riding the tech train for so long. If you told me we'd launch the wealth management business and have, have an 11% allocation in financials, I would have thought you're crazy. But that's been where a lot of movement is. So that's growth, and then over here in the value portfolio, which it's not a value portfolio, it's a group of stocks that, one, have to pay a dividend, two, go through our quantitative fundamental scan and requirements. So, have to pay a dividend, have to be, have increased the dividend, and meet certain fundamental criteria. But over here in the financials, we're at 18%, so pretty overweight there in financials. So, and if you kind of look at where we are in the actual financials, let me just go over here to the relative rotation graphs, which is a great sort of visual representation of how sectors are rotating in a clockwise manner around some central benchmark, either the S&P or some kind of all stock ETF that I use. But what we're seeing here is we're obviously getting a good rotation into growth, and even small and medium cap growth out of value, which again, a lot of people were not expecting. We did up our technology exposure in the dividend portfolio when we rebounced in February. Kind of thought this was coming, and we're seeing it. So the question is, financials are rotating out, and it's like, do you want to reduce some of our overweight exposure to financials? And in this video, hopefully this is going to be, I really want this to be like 7 or 8 minutes. I'm going to go quick. I think I'm going to get to the answer being no right now. Okay, so let's just kind of set this up here. I should have this in order here right off the bat. So, okay, so here's 210. Here's the 210 spread, okay? 2-year yield is in purple, 10 is in green, okay? And then the actual, the spread, okay, is going to be, actually, no, sorry, let me do this quick. Sorry, I'm already off script. Let me bring this one over. Okay. Sorry, one sec. Let me pull up a new wide charts window here. Let me just kind of start from the beginning here, and I'll give you a 210 chart here, kind of show you, kind of set the tone here. We'll do 10-2s, and then I'm going to throw, there we go. Okay, so So this is the difference between the 10-year yield and the 2-year yield, and that's all pretty much everyone's talking about, is the 10-2 spread. And Kelly Evans on Power Lunch is I think, been the exception. She's really tried to bring the maturity shorter than 2 years to the surface. And so we'll talk about that right now. But here's what everyone's talking about is the 10-2. So the difference, we're within, we're almost at parity. So this needs to update. These are usually 1 day behind. So this should go to about even. And, historically speaking, when that happens, you are looking at, recession. So I can just bring this over here, show U.S. recessions, and I'll go max. So when you get, typically when you get to the low end of the spread, like late 80s, you have a recession that follows. Just after the tech bubble pop, recession that follows. This actually, same thing here. This is 08, 07, 08, go into that recession follows. The big difference here is, again, the starting point for the 10-2 spread is much different. It's much lower than we've seen in prior cycles here. So that's the first thing. And the second thing is, I think too many people are looking at just the 2-year and ignoring less than a 2-year. And that actual yield spread tells a much different story. All right. So from there, let's go back to something shorter here. So what we're doing now is we're looking at the 2-year yield, which we just spoke about, subtracted from the effective federal funds rate. So where the Fed sets monetary policy. And you can see that we've seen a pretty sharp move up here in the spread. As this thing goes higher, the spread between where the Fed funds rate is set at the meetings and where the 2-year rate is, we've seen a pretty sharp move up there. Okay. Now, does that mean that the Fed is way behind the curve and interest rate hikes, many of them, 7, 8, 9, we've heard all sorts of numbers, are definite? And the first thing I would say is no, because it got up to actually a higher spread of 2.09 back here in 2002. You can see the 2-year yield in purple went much further than federal funds, and you could say the same thing now that was probably seen back then. Oh, Fed's going to raise rates, Fed's going to raise rates. And what happened was actually federal funds went lower. And the NASDAQ actually bottomed like 5 months later and then went on the rally into the 08 high. So, sort of the same thing. We had an elevated 2-year yield here in purple relative to where federal funds was, up around, not quite where we are now, but 2-year caught back down to the federal funds rate where it stayed low for a long, long period of time. So the question, that everyone is saying is the yield curve inverted or not? And it depends on, where you look. So if you look at the 10-year yield minus the 3-month yield, which I think more closely resembles where the Fed funds is, and also where financials deal. And this ties me back into the discussion about financials. If you look at the spread, it's actually steepening and it's getting steeper. It's been flat for a long period of time. So the yield between the 3-month and the 10-year is getting wider, which I think that's actually good for financials. All right, so let me get into this. So net interest margin is the difference between, this is basically how banks make money. They borrow from your deposits, my deposits that they pay us, peanuts on, and they lend out in longer term loans, and they make the difference between the two. And I think everyone's pretty comfortable with that at this point. And if not, you certainly should be, because again, that relates back to a normally shaped yield curve and the shape of a healthy yield curve and a good economy. And specifically, that's when financials should do well. So here's where I've kind of been doing the research, and I've got some, I think, fairly solid takeaways that I want to put in front of you, and I want to put out to our community, which is everyone out there, and tell me if there's something I'm missing. So the Fed was putting out this net interest margin report up until 2020, Q3 of 2020, and they discontinued it. When they left, they were showing the net interest margin for all banks. And it was a nice report, and I really wish they kept it going. But it was up around 3%. Basically, what that means is the liabilities the Fed had on the balance sheet, that were paying X to our deposits, okay, that we have with the banks, and then loaning out at much higher rates and capturing the difference that is net interest margin. Okay, so then that kind of pulls us into this, which is called maturity gap, which, as it says here on Investopedia, is the difference between the total market value of interest rate sensitive assets, that's the key part, versus interest rate sensitive liabilities that will mature or be repriced over a given range of future dates. So it's interest rate sensitive assets minus liabilities, which is essentially where that maturity gap comes in. So I'm going through here and I'm like, okay, because everyone is saying, specifically financials, but everyone's saying get out of financials and a recession's imminent because the Fed's going to be forced to raise rates because of where the 2-year Treasury is. I had two problems with that because, as I showed you before, we've seen other instances where the 2-year yield went up and the Fed didn't raise rates. Maybe they're behind the curve, but eventually that 2-year yield caught back down to where federal funds was, and it took a while for actually rates to go up. And then the other part is, do you want to rotate out of financials? And I listened to the guys on Fast Money Half, and they're saying absolutely get out of financials because that 2 years going up. And I said to myself, like, wait a minute, hold on. Where are banks actually borrowing? What maturity? What is this maturity gap between average duration of assets on the balance sheet minus liabilities? And I did some deep diving, and I'm going to tag Tom Lee in here because I think he's probably the only guy that I know who would have the team to go in and actually get the answer to this. But here's what I found. Okay, so first thing is this is the Federal Reserve website, and I'm just looking at this is a record of all assets and liabilities as of, I think this is a recent report, March 25th, 2022. Perfect. Okay. So I'm going to go down to table 3 here, which is, sorry, here it is. Go down to table 3. So this is selected assets and liabilities, commercial bank, percent change. No, I don't want to do that. The next one is assets and liabilities, commercial banks, seasonally adjusted, billions of dollars. Now we'll just go down to non-seasonally adjusted, table 3, assets and liabilities of commercial banks in the U.S. So basically what we're doing is I'm just going to show you of all commercial banks in the U.S., total assets is about $22 trillion right here for February 22.5 trillion. So that's 22,677 billions. So this number's in billions. So I'm not great at math. I believe that's 22 trillion. If I'm wrong, please tell me. Then we get down to the liabilities. Okay, total liabilities is 20 trillion. So the net residual assets is $2 trillion. Okay, fine. What I find interesting on this is the liabilities. There's not a lot of detail in here. Okay, so the total deposits, 18 large time deposits. I tried to look into that. I couldn't read it. I'm not smart enough. Other deposits, I find this really interesting. 16 out of the 20 on in liabilities is other deposits. So what the heck does that mean? Okay. So then let's get into it further. So I did some pretty deep dive trying to find what the average duration maturity of short-term liabilities on banks' balance sheets, and this is the best I could come up with. It's not a lot of data before like 2018 and 19, especially because that net interest margin report was discontinued. So banking on deposits, this is a white paper written by these guys. I don't know if I can pronounce any of their names, but they must be extremely credible. So I'm going to go over here, and this is the same one, same report. And this is what I found to be very interesting. Banks do in fact engage in significant maturity transformation. So again, that's that maturity gap concept. From 97 to 2003, the average duration, let me see if I can shrink this. From 97 to 2013, the estimated average duration of aggregate bank assets is 4.3 years versus only 0.4 years for liabilities. That's a 3-month yield. So the average maturity of their liability on their balance sheets, according to this, is 4 months. Here's the next thing, Cleveland Fed. Okay, this was unfortunately published back in 2014. I'm going to try to reach out. I doubt I'll be able to find an email for William Bednar, but he was contributing author and former employee of the Federal Reserve Bank of Cleveland. Tried to find an updated report, couldn't find one, but I thought this also confirmed what I found. Average maturity of assets based on percentages. Over 30% of them are 5 years, 1 to 5 years, just slightly less. So 60% on average of assets are between 1 and 5+ years of assets. Okay. Keep going. Maturity of loans. That's not what we need. We need liabilities. Average maturity of liabilities for small banks. 35% of them are under 3 months. 15% of them are between 3 and 12 months. So we have, let's say, 50% of maturities for small banks are under 12 months. Again, that points to shorter interest rates below that 2-year curve. Let's go back to maturity of assets of large banks. No, that's not what we need. We need liabilities of average maturity of liabilities, large banks. 55% of them are under 3 months. 10-ish% are 3 to 12 months. So you have probably 2/3 of maturities under 12 months on large bank balance sheets of major institutions. Okay, so when I look at the financials, and based on everything that I just said, I look at the XLF financial sector spider. Again, I don't see any kind of bear market setting in there. I see a market relative to the S&P that 22 has been a little stronger on a relative basis, but I just can't help but wonder if too much, as we're seeing a rotation out of financials because of the move in the 2-year, is there, perhaps this is a little premature to rotate out of financials. Personally, guys, we're active management. I don't care. I'm not married to any idea, but I just wonder if too much has been put into this 10-2 spread. I wasn't able to find a whole bunch more than what I just showed you as to the average maturity of liabilities in the bank's balance sheets. If you know something better than I do, please let me know. Please at me. So let me just get any questions. Is that you guys are all quiet? Anyways, yeah, no, this has been a I've left this YouTube channel for too long. I apologize. We'll certainly be doing a lot more of these and regaining your attention. But let me know what you think on that. You can certainly write me at Todd Gordon TA on Twitter. We're at New Age Wealth, and hopefully you guys enjoyed that. So I'll just do a quick one here and going back to work. See you guys.